All right, so we'll go ahead and get started. But if you guys have any questions at the end of each slide, feel free to ask. As we go, I'll probably answer a lot more of your questions, but I'd love for feedback on whatever it is that you want to learn about or want more of an explanation. Let's see. Okay. So here we go, purpose home loans. I call this presentation everything a realtor needs to know about the mortgage process. The main reason, I like to do this class and kind of why I got my license is at one point in my career as a realtor, I mean, I've gone through probably 18, 16 different loan officers or loan originators who just absolutely drove me crazy. And I could never really figure out why. And what was going on, with their processes. And I learned a lot as I went. I mean, my first client, people kept telling me that he was an FHA buyer, and we were looking at condos. This is 2019. We were looking at condos all over Roseville, but it's hard to find condos that are FHA approved. Sorry, Roseville and Sacramento. And then I come to find out that from another individual, they said, well, tell me more about another realtor. They said, tell me more about your client. And I said, well, he's putting 10% down. He's got a 700 plus credit score, first time home buyer. And they laughed and they said, he should never be going FHA. He should be absolutely conventional. But what ends up happening is some of these loan originators want them to go FHA because they know in 6 months they can refinance them to conventional. And so it's a guaranteed second client in 6 months. And it's technically illegal and unethical. And there's ways they could be violated for that, but there's ways that they can try to say, oh, I gave them the option, but I was never given the option, and he was never given the option to go conventional. I mean, they had talked about it a little bit, but not really. So as I've gone through, I think there's, and I've experienced, on the buyer side, pretty much being a processor for a loan originator, who had no idea what he and she, there were two different ones, what they were doing. And they were busy taking vacations because they were just making a killing from refinances. And so they just didn't really care about my purchase. And so I was on the phone with some of the actual lenders, which people think is banks, but they're lenders. They're lending the money. They're not a bank. But I was talking to a lot of those lenders, and they're saying, wait, what's your position again? And I would say, I'm the realtor, but right now I guess I'm acting as the processor, which for us realtors, that's like a transaction coordinator on steroids. So they know all the regulations. They work a lot more with the underwriters. They collect all the documents. Like, the loan originator should put a lot of focus into the sales part, getting the customers, building relationships, quoting them on what product to go with, which means, loan, and then getting it into contract, locking the rate, and then passing it off to the rest of their team. Because that's how and then keeping everyone updated as you go, but letting their team kind of, drive the rest of the process. Well, I was the one going to the actual bank for my clients, with my clients, asking the bank teller for what documents we needed in order to get the loan done. And it just drove me crazy. So I think as I've gone through the industry, I've experienced a lot of really experienced listing agents who don't understand the process, and ask weird questions. And I'm like, well, I don't think you fully get it. And I've also experienced loan originators who don't even understand the process. So I'm going to kind of give a step-by-step talk on how this works. You all can see my screen, right? Or am I not even sharing my screen? All right. Well, this was the slide I was on. Okay. So yeah, everything you need to know about mortgages. So I like to start on the initial call. Now, as a realtor, you have to remember that this is not a face-to-face interaction. For those of you who worked a lot of leads, you understand the value of meeting with that person face-to-face right away. For a loan originator and for you as the realtor, You don't always want them to do that, right? Some loan originators, they really want to meet with the client face to face and have that buyer consultation, but you have to be able to communicate what the timeline looks like. Because I've lost clients because they were ready to put in an offer after I spent 2 days showing them houses, and then the loan originator wanted to meet with them in person, and the only date they could meet was Wednesday afternoon. The houses were off the market. They ended up going to a new build without me and without the loan originator. And now, and I'm going to say loan originator because loan officer is a made up word. It's technically our licenses say mortgage loan originator. But the loan originator, did not meet with them. So you need to make sure that everything's big on communication. Like you and your loan originator partner, it's a partnership. Absolutely a partnership. And so you have to make sure that you communicate everything with them and set the expectations. Hey, I just showed them a ton of houses. Like I really need a pre-approval. Here's the client. They might be interested in putting in an offer here soon. But then that loan originator should respect that. Like the fact that this other individual decided to meet with them in person down the road because that loan originator felt they would lock in the client by having that face-to-face interaction, ended up screwing me over and screwed them over as well. So we got to make sure we communicate, but then we have to have expectations that we communicate as well. Because I've also, when I went from being a realtor to getting my mortgage license, I really started to learn how crazy some realtors' expectations are of a loan originator. Like you need to be able to communicate, how are you passing off a client to them? Like what should be that handoff? Like me, I prefer you put us in a group text because I have seen it from my own clients as a realtor and whenever I've been connected to a client on the mortgage side where they say, oh, the loan officer or the loan originator never reached out to me. And it's okay. Well, yes, I did. We all saw it in the group text. So that's what I prefer. Lots of people say, whatever way you want, but I just think that it's right. Adrian passed someone off to me and we're both looking at the group text wondering, why aren't they responding? And so then it's nice because, we can communicate with each other and say, hey, they haven't responded. Should I call? Should you call? Hey, maybe they're at work, whatever it might be. But yes, I would communicate that. And remember that it's not face-to-face for the loan originator. You're the one who builds the strong relationship with them up front. This is just the person over the phone. So it can be a little harder, and the warmer you can make that handoff, so the more that you can sell that person, the better. So I should have skipped these 2 bullet points or put them closer together. So this is something that I've been learning because, right, I'm not with you all every single day. I'm not with you all when you all go and talk to your clients. And loan originators aren't as well. So you know what you say to your client and not. And so I went through a period where I think I had about a year and a half where every single buyer client, unless if they were cash, used the loan originator that I referred to them. And the loan originator kept saying, I don't know what it is, but you're my best referral partner. What do you say to people? And I've learned that a lot of realtors have a hard time selling that loan originator or don't even really try. And so what I would say is, what is it that you expect the loan originator to say about you in order to sell you to their client, right? Because if I pass my client off to a loan originator, an LO, and they call my client and I want them to talk me up and sell me. But what is it like? What do I expect them to say? Oh, yeah, he's a pretty good realtor. You should definitely be giving him a shot. No. But why is it then that a lot of realtors say that about the loan originator? Hey, maybe you should try to get a second opinion. Here's a loan originator. They're pretty good. You should give them a shot. I trust them. I would go a little bit farther, but also remember that when you make a good recommendation to someone, they love you for that. Like I love referring this one painter that painted the outside of my house. He's painted the inside of Chanel and Nate's house and painted quite a few other clients' houses of mine. Whenever I refer him, they always call me and they go, oh my goodness, thank you so much for that referral. He was absolutely amazing. He did a great job and he was pretty cheap. And so I greatly appreciate it. It's going to be the same thing for you as a realtor when you refer that LO. and you do a really good job selling them. But also, you might want to have a conversation with that LO and talk about, hey, here's how I'd like you to sell me. Here are kind of the key points. This person kind of seems like a bulldog client, like they're going to try to drive the process. So can you really sell my experience? Sell my expertise, sell my ability to negotiate. That way it can only help me down the process, down the road. What is or should be the purpose of the initial call? So you're going to hear all kinds of different ways that LOs will handle the initial calls. Some will say, I'm going to take the application on that initial call. If you ever want to, I would just play around. If you have an LO partner, you can go to mine, you can go to someone else's. But I would go through their application process and just see what it's like. We can change some of the questions so that they're not as confusing, but a lot of that information has to get auto inputted onto it's called a 1003 application. So even though it might be a guided application that asks them questions, they'll input that data onto the 1003 that we legally have to have. So there's some things that the client has to attest to. There's some things that just they have to put, but should the LO always take the application up front? Not necessarily. I think taking the application up front it could possibly do a couple things, but it's definitely doing one thing. So a lot of times, I'll send a link to someone and they never fill it out. And I've found that realtors will think, well, why don't you do it over the phone? They would have completed it. It's like, well, that's not the only part of the application process. I still have to get documentation. I need their driver's license. I need their last 2 bank statements. I need their last 2 pay stubs. I need usually their W-2s. I need their employer's contact information. I need a lot of different things, and I'm going to need more things as the process goes on. And if they can't take a little bit of time to fill out the application, I'm having a hard time believing that they're going to also take the time to log into their bank and download these kind of documents. And those 2 things, or collecting documents, I can't do for them. So as partners, we have to say, hey, why didn't they fill it out? How do we push them to fill it out? How do we push them and advise them on the importance of getting everything as quickly as possible to the LO? The real purpose of that initial call, and possibly even taking the application over the phone, is I like to ask the questions that's going to lead me to, one, what documents do I need, but also what loan product do I need to look more into? So I get on the phone with someone, right? They say, oh, I say, well, how much do you currently make at your job per month? And this is one that Dylan passed off to me recently. She says around 14,000 or something like that. And I said, okay, that's great. You're making a killing. Maybe it was 18,000, so is that all from, one job? Or you W-2? And she goes, oh, well, I own my own private practice. I go, oh, that's awesome. And then she said, and I also work, a teacher job, which is, a teacher job where I teach 1 class a semester. And then I also work a state job. And I'm like, okay, this is getting interesting, because one of them has to be part-time, which for certain loans, it just depends how long you've been doing that for. It becomes an issue, right? And so, okay, hey, how long have you had your private practice? That's so cool that you have that. Well, I started in August and I make great money. Boom. In my head, I know whenever you're self-employed, you need 2 years of that. However, if she's making an absolute killing, if it was a 1099 type of self-employment, so she gets a 1099 from another company, and she has experience from her job for the last 2 years, there are certain loans available that will look at that as a qualification. And so that's where my mind immediately goes to. And I'm like, okay, if we need that, I'll try to look into that route. Well, how much do you make at your regular state job? Oh, well, my state job and my teacher job are both salary, which boom, I know, hey, I can qualify both of those incomes. And I've been doing them for 5 and 6 years. Okay, I can qualify both those incomes. How much do you make? Okay, well, you make enough from that versus the price range you're looking at. I think We just need those. We'll totally ignore your private practice. I think that's great you're doing that, but you do not want to try to have to qualify that in your income, right? This is what happens in the initial call. When people say, oh, I've got this much to put down. Okay, where is that money coming from? Did you save up that money? Is this from a 401k, an IRA, a whole life insurance policy? And sometimes people will say, oh, I've saved up some and then my relative is going to give me a gift. Okay, perfect. We can go from there. And sometimes people say, well, how much do I need to put down? And then we can kind of talk about, and I can say, well, I'm going to show you the examples, how much ideally, I always say, how much do you want to spend out of pocket, right? Because there's going to be closing costs and there's going to be down payment, and they are two different things. But people usually, when they say, I want to put this much down, if they're a first-time buyer, they mean I want to spend this much total out of pocket. Hopefully that makes sense to everyone, because I've had realtors tell me, oh, they want to put, or Chase and I experienced this. Chase puts it in his contract, that he's putting 60,000 down. And he said, oh no, I told Cameron I'm putting 75,000 down. Chase calls me and he goes, he wants me to change it on the purchase agreement to 75,000 down. I'm like, well, I mean, you could put that because who cares? It's not really changing the contract, but no, he wants to spend 75,000 out of pocket. So that extra 15,000 is going towards this. That's how much his closing costs are. And, right. So we have to make sure that we communicate that, at a later slide, I have, why do things fall out of contract? It's because of stuff like that. Because, he went and he shopped me at a local bank. And so he went and asked the bank for a quote from them. And he said, well, their monthly payment seems a little lower. And I said, yeah, because they're also going off of you putting 75,000 down. But don't forget, you're going to have another 2% in closing costs, which means you're going to spend more than 75,000 out of pocket. You're going to spend 90. And right, I understood that. Did someone ask a question?
It was me. You didn't have to stop right away.
Oh, go for it.
This was something that I know I got really confused with, because even like the Fidelity app or whatever it is, where you can do the what's the name of it, where you can summarize what their closing costs are going to be, their net sheet.
Yeah.
In there, like I did that for a client, and it's like, oh, this is, what it tells you, what you're going to need to owe, based on what we decided on the contract with negotiations for what the seller pays, what you pay, blah, blah, blah. But then there were also lender closing fees on top of that.
Yeah,
right?
So it's never going to be fully accurate, and that's why, and we'll see, I'll cover this in a later slide as far as closing costs and stuff like that. But when you're using those apps, you're just giving a rough estimate. It is factoring in somewhat standard, the Fidelity app lender fees, but every lender is very different. And so as a broker, I have access to, or we have access to about, I don't even know, maybe 15 different, technically we could add whatever lender, but they all have different fees and they all have different costs, depending on if my processor is coming, if I hire a processor myself, I have to pay that from my own commission. I cannot put that on the borrower. I don't fully understand why that is, but that is the thing. So sometimes it just depends on the lender, who I can offer certain discounts to and why not. So, but I'm going to cover that on a different slide. The main thing for everyone to understand is that initial call, I'm not trying to take the application, because I think I need to send them the link so that they can attest to certain things. That way they never can come back at me and say, oh, I never said that I didn't have a foreclosure 3 years ago. Well, yeah, you did. You filled out the application yourself versus me filling it out. So I just like to ask that preliminary questions, because it's going to then take me some time to go and find out, for certain situations, what are the best programs available. And it's not straightforward. So in another slide, I'll talk about grants, but then there become the requirements of, okay, you have to be at or below the median area income that's put out by HUD, something unit development, whatever, housing, whatever. Right. And so I can't just give an answer right away to everyone, especially if they're self-employed. I know that it's always going to be a lot trickier, because the way that they calculate income is so different. and they're always going to also look at your profit and loss statement. And so there's a lot going on. So sometimes that initial call, I can say right away, hey, listen, they've been at the same job for the last 3 years, 4 years, 2 years even. They get paid the same amount. They're sending me a pay stub. I think it's going to be a no-brainer. I'm even looking at their debt to income ratio just not based on what they said. And I think you're going to be good to go, but let's wait to see, what documents they provide. Other times it's, hey, you got to give me a little bit longer because they pay themselves a different amount every single month. Like I had a person recently that pays themselves different amounts every month, and it didn't look very good. But then when you looked at his last 2 years personal tax returns, he makes a killing. And so it just takes diving into those documents to figure that stuff out. Next is my goal, and I always remember these two realtors getting pissed off with this LO because they kept passing off clients, and he pretty much was like, you're pre-approved, here's your monthly payment, and just, I'll send the pre-approval letter to your realtor and just let me know if you need anything. And the people saw the monthly payment and thought, oh, well, screw that, I'm just going to rent. And the realtors were getting pissed off because they felt that was the LO's job to sell the benefit of buying versus renting. Now, I think that there's things going on there, right? As the realtor, I should explain to the LO, hey, they're really actively looking, like I can tell right now that they are ready to go and they're going to make a decision. Other times I have to say, hey, it's hard to feel them out. I think they're just kind of looking into it. And they're just, kind of getting their feet wet, looking at houses, and as the lender or the LO, I should hear that and say, okay, I'm going to put a lot more emphasis into selling the benefits. Like Dylan Wynn, when he passed off that client, she's debating renting versus owning. And so I can even show in a calculator, hey, listen, your monthly payment for your house is going to be more than a monthly payment for a rental house. However, if I look at it in a 5-year period, just my appreciation alone is going to make me so much more equity and money for the future than me saving money by renting, right? Because values are still going to go up. So even though you think you're saving money by renting, you're actually losing out because values are constantly increasing. So I knew, because Dylan explained that to me, that I should take that approach with her and get her more excited, right? I can't always say the perfect thing to win over every client, but I want to say as much as I can to increase my odds of working with them more in the future. So should the LO bring up credits from a seller? This is a big one that I've been noticing. People say, oh, ideally, I don't want to spend that much out of pocket. Sometimes there's LOs that are like, okay, well, just ask for a 2% seller credit. And then you hear that and you're like, okay, as the realtor, I'm showing them houses that are getting 5, 6, 7 offers. What the hell do you mean 2% credit? Like they have to have that. And I find a lot of you will call me and say, hey, the LO is saying that I have to get a 2% credit, but I just don't know how we can do that because they have so many offers. I said, well, do they have to have that credit? And a lot of times I'm hearing from all of you as realtors, I don't know. And so I always say, well, go back and ask the LO, do they have to have the credit? Because this is a very competitive price range and housing market that they're looking in. And almost every time it comes back and the LO said, well, they don't want to have to spend this much out of pocket. So ideally they should get the credit, but they would be okay with not having it. It's like, come on, we could have saved a lot of time by just communicating that with each other. Hey, when I brought up closing costs and how much they have to put down plus closing costs, that was a little tight for them. They have the money in their account so they can make it work. Well, then let's talk to them about, hey, if it's the perfect house, then spend the money if you have to compete. If it's not the perfect house and you can get a credit to cover that, then great. If you can't, then let's move on to the next house. Hopefully that makes sense to everyone. So that's the communication aspect. Like I think whatever expectations you have in your head of what the LO should or should not do, you have to communicate that because the LO is going to take your lead too. So they are going to have certain expectations that they need to communicate to you. It should always be cross-selling each other, and it should always be pushing the client that whenever the LO or the processor ask for certain documents, you get it to them right away. Because in purchasing, we have time frames that we have to hit, and one document, unfortunately, could lead to five, needing five more documents. Like I've seen someone provide something and it was, oh, well, great, thank you for providing it, but this actually just opened up a huge can of worms because whatever. Sometimes that's a bank statement because they had five purchases, over $2,000 in the last couple of months, and now the bank's wondering, hey, is this a recurring bill or not? So yeah, I would just make sure you communicate with your LO. Hey, like, what are the expectations with every client? I mean, it's just communication. So if I'm thinking in my head, oh, they should have done this, if I haven't verbalized that to them, then there's no reason why they should have done anything. And so that's the same thing with relationships, but I've just found that it is a big mistake people make. Okay. So I want to get into these different types of loan programs. So I'm going to go kind of quickly through these just so that you guys get a general idea. Conventional pros and cons. And this is based on government agencies. So conventional can get sold with Fannie Mae or Freddie Mac. Those are the two government agencies that buy loans. They buy all the rest of them too, but they put out the requirements, right? Banks and lenders will have additional requirements on top of the standard requirements. They call them overlays. Sometimes it's not called overlays. It's just is what it is. So you might hear some banks say, we'll do a conventional loan, but their debt to income ratio cannot exceed 43%. So their income or their monthly payment on all their debts cannot exceed, monthly payment on all debts cannot usually exceed 48% of all debts, including their housing expense from their income, 43% of their income. So, or 48. I wouldn't worry about the percentages. The only thing as a realtor that you really need to be concerned with is every lender has different requirements. Like technically we have a lender with a conventional loan that they will go up to 50%. So all of your monthly bills, including your housing expense, cannot exceed 50% of your income. Whereas most other lenders, it's 48%. Sometimes it's 49.1, depending on credit score and down payment. So it's good to know that, but also whenever people say, and I have this again in another slide, hey, do you always shop for the lowest rate? No way. Unless if I need to in order to get them qualified. The problem when you shop for the lowest rate, and I am going to run some scenarios here in a second, and let me make sure that screen doesn't, is it doesn't always, if I could save 0.25% at another lender, it's not always the best option for the client because they could have higher mortgage insurance because every lender will choose the mortgage insurance provider because it's an insurance company. Mortgage insurance is just if the bank had to sell the house because you foreclosed and values dropped, they can make up that difference from what you owe through the insurance and what they sell it for through the insurance company. So the nice thing about conventional is typically, if you're putting 20% down, it's immediately no mortgage insurance. There are some that have lower mortgage insurance rates. You can do a lower down payment. So for first-time home buyers, it's 3%. And then 5% if you bought before is the minimum. Lower closing costs, like I said, it can be roughly 2%. FHA pros and cons real quick is their closing costs, because you have to pay upfront mortgage insurance. It's about 6 months of mortgage insurance upfront. Plus you do have some mortgage insurance down the road. So like I had a client who they had some cash, but their debt to income ratio was off. So it was better to go FHA because their mortgage insurance per month, it's a set amount. So it was about $200 to $300 cheaper per month, just because with conventional, their mortgage insurance was so much higher because of their credit score. It's not straightforward. So a lot of times realtors will say, what's the monthly payment for a conventional? Well, it depends dramatically on the loan amount, their down payment, their credit score, their rental history, how much debt they have. I mean, it's a huge factor that I have to put into a system. So for me to even, I can't really give a quote. You can give just rough estimates as a realtor because you're not like you're not an LO, but it also depends too on their homeowner's insurance. Try not to go off on too many tangents because my mind will. Conventional does have a little bit stricter requirements, whereas FHA, these are really for the loans for people who don't have as good credit. They have higher debt to income ratios, but of course they have to put more down. So they have to put higher DP, down payment. They have to put 3.5% down. They do have higher closing costs. So closing costs usually for FHA, I'd guess around 3%, but I would just have your LO give a better number if you did need it. They should always be disclosing that to the client as well. But you can have higher debt to income ratio. So you can go up to 55% of your total debts to your income. There are down payment assistance programs that are run through FHA. So I'll cover some of those later. And then you can have low credit. Like technically have at Purpose Home Loans, we have access to one lender who will, if they have zero credit, we can do the FHA loan. The problem is it comes at so much higher of an interest rate. Like I'm probably talking 8.5 to 9% right now if they have literally no credit, because it's riskier, right? And so if someone is making a killing, which I've met these people, but they have no credit because they've just never worked on their credit. Same thing with VA. VA can do that as well. Well, if you're making a good amount of money, we can still do it. Wait until your credit improves and then just refinance later. So VA, pros and cons is it can be 100% financing. Same thing with USDA. You typically have lower rates with FHA and VA. And I said typically because at one point in 2021, conventional was actually lower than FHA at one point. But VA, typically better rates. If they have a disability rating, they can waive. There is an additional closing cost fee that the VA charges. And remember, VA they insure it, and so does FHA. They insure the loan to whoever is giving the money. But with VA, if they have a disability rating, they can waive that extra funding fee, but it does not mean they won't have closing costs. Because I've had my own clients think that meant they had no closing costs, just because the lender never explained it to them. So the funding fee, it varies, and so it's usually around 1%, an additional 1%. If they've used the VA loan multiple times, then it goes up, obviously. So a little bit higher closing costs, higher expectations on the seller because they do have to provide a cleared pest report, but it depends. Some lenders will allow you to provide, it's called like an NPMA, basically is a form that the pest company provides that says there's no active pests, but that's lender specific on what they require because it's not clear in the VA guidelines as to what it is. And sometimes people just get used to doing things one way that they think that's how it is. So if anyone has any questions, you can talk to me about that later. USDA, you all will probably hear because you don't have to be a veteran. You don't have to be anything else to get 100% financing with no mortgage insurance. That's the other thing that's nice about VA and USDA, no mortgage insurance. However, this has to be a rural property. And so you can literally Google USDA rural property requirements, and it has to do with how many people per capita. And so then you have to look up that city or count. Usually it's the city to find out if it would qualify for USDA. Also, you can look it up on the USDA website. The nice thing is they'll take the total household income. So if you have teenagers working in your house, whoever, they'll take everyone's income, even if only one person is on the loan. So I had last year, someone up in Grizzly Flats, wife is the only one with credit and like consistent, work history, but we were able to count her two other children who also live in the home and her husband, their income into qualifying. The weird part about this is they're very strict. So your debt to income ratio cannot exceed for your housing bill 29%. right? For conventional, it's 43%. So that's a huge difference. It's not it's a loan, I think, to start conversation with people, but for most people, it's not the best option. It's going to be hard to qualify. It's more if your household makes a good amount of money, but you have no money saved. So, anyone have any questions just about these specific loans? Check the time. Dang, time is flying. Okay, moving on. This is some of my favorite stuff to talk about that I was excited about. Okay, first time home buyer programs is Bigfoot. I didn't know how else to make that title. I hear all the time, hey, I'd like to take advantage of a first time home buyer program. I don't like to correct people and say, actually, there is no first time home buyer program. It's just for a first time home buyer, you can qualify for more, it's more lenient, right? So I can put 3% instead of 5% down. They're a little bit more lenient on my debt to income ratios and my credit score. I get access to down payment assistance programs. Sometimes there are grants. There are not a lot of grants available. Some credit unions might offer some grants, but typically no. A lot of times when it comes to grants, it's usually based on income. And so if you are a low income earner, you can probably find a grant available. Whereas down payment assistance programs, there aren't, it's not necessarily, most of the time, it's not income related or even credit score related, because it's a second loan or a forgivable second loan. So there are down payment assistance programs for all of you that pretty much operate as a grant. So it's nothing that you have to make an extra payment on, whereas there are others that you have to make an extra payment. So for instance, we have one lender that we can go to called WestGen. So they have a forgivable down payment assistance program that you have to be in the home for 10 years. Otherwise, you get a prepayment penalty, or they tag on the interest. So if I refinance that before 10 years and pay it off, yeah, I have to pay off a lot. But that interest rate, because it's riskier because they're not making any money on that extra amount they're giving you, it comes at like, most lenders it's 7.75 to 8%, which knocks most borrowers right now out of qualifying. But there are other ones that are, it is a monthly payment that you add on, so it's just principal and interest payment back, but it's more, it's probably 7% or 7.25. So for those people who need this is where I pass off a client who needs down payment assistance programs, or they need a grant. The lender is going to need a little bit more time to look into where rates are currently at. It's a lot harder to calculate that, but there are things available. And there are a lot of down payment assistance programs that will then allow you to get more of a seller credit as well. Whereas conventional, I'm putting less than 10% down, the most I can get from the seller is 3% as a credit back. If I put more than 10% down, then I can get more, but I just have to have that much as a credit. Does anyone have any questions about that? I put teachers, medical professional, first responder programs. Some companies lenders will, their down payment assistance is only for first-time home buyers, unless if they're a teacher, medical professional, or first responder. And they're all very different on sometimes what they consider as a medical professional. So you can just always ask, but this stuff is also great conversation starters. It's a great way to capture leads, because technically I can buy a house with no money out of pocket, because I can ask the seller to pay for the appraisal. I can ask a lot of things. I can have the seller pay for the inspection reports. If there's a house just sitting and I'm going to give them the list price minus, let's say, 3% as a credit back to the borrower, and they're getting down payment assistance, I can come out of pocket nothing. I have seen it too, in 2021 when the market was crazy. If someone had, let's say they had 20,000 that they were going to put down, and they were writing offers and people are offering appraisal gaps. Well, what the lender was saying is, okay, if the house doesn't appraise, then we're going to switch to this lender, and we're going to use their down payment assistance program in order to cover that appraisal gap. Does that make sense to everyone? It's a little confusing, but if we ever get into very competitive markets again, if rates drop, that's something we can always offer our borrowers. It's a lot better and will save them more money than if they just spent it out of pocket. But that is an option. Someone did that to me, and I was wondering why we delayed a whole nother month. And it was because they switched lenders and used the down payment assistance to cover the difference between the appraised amount, and the purchase price. Okay, other loans. So there are DSCRs. So that means debt service coverage ratio loans. This is one that honestly, in today's market with rates where they're at, I would be learning. You don't need to learn a lot about it, but you just need to know about it. And when there's duplexes or houses for rent, people don't have to have any income. If I have a decent credit score, like for a lot of you realtors, if you go and you close a couple deals, you save enough up for 5%. You can technically, even though you've only been a realtor for a year, go buy a duplex where the other side's rented out, as long as that rental amount covers your payment and it's cash flowing is essentially what they look at. Or duplex, triplex, quadplex, so 1 to 4 or 1 to 4 unit, but really it'd be 2 to 4. You don't have to wait to be a realtor for 2 years in order to qualify. They won't even ask for your income. They're just going to ask for your credit score and your down payment. For certain properties, if it gets bigger and if I'm buying it, if I'm not occupying the property, it's going to require 10 to 15% down for these DSCR. There are down payment assistance programs coming out for some of these as well, but you have to occupy one of the units. So if you all see a listing and you want to run some, Chase wants to make a cool video and put some catchy slogan on it, I'd look at duplexes that are for sale that aren't selling. Same thing with triplexes and quadplexes, because there's a lot of them that have at least one empty unit. And technically someone can get down payment assistance to buy the property as long as it's cash flowing. So we can always talk about more of that later. Now, bank statement, this is more for someone who, a self-employed person who deducts as much as they can. So let's say, typically for a self-employed borrower, they're going to take my last 2 years of earnings, my last 12 months, and they are going to do an average and divide it by, or they're going to take all of those last 2 years, my net, not how much I made, but after I deducted everything for my last 2 years, and they're going to divide it by 24. So 2 years, 24 months. And that's how much I make per month. So as a business owner, I deduct as much as I can. And so that can be frustrating because then I think, well, if I deduct too much, then I can't show that I make enough on paper. But there are bank statement loans that come at a little bit higher of an interest rate, where they're just going to look at my last 12 months of deposits. So how much I made in the last 12 months or 24 months. And they're just going to base my income off of that. They're going to take an average of that, and that's how much I make. It's really good for those business owners. I showed someone recently this option. I just said, yes, your interest rate is maybe 0.5% to 1% higher. But if you look at it, how much you would save, you actually save more by deducting as much as you could versus, the monthly payment being a little bit lower. If that makes sense to everyone. Okay, so I-10, I have to make sure this stays open. It'll log me out. So I-10 and foreign national loans. So someone doesn't have to have a social security number, but they cannot get a traditional loan. If you're not a US citizen and you have a social, because you can have a social, you just can't do any government loans. So no USDA, no FHA, obviously no VA, obviously. But for I-10, that's their identification tax, independent tax. Anyway, there are loans available. They do have to put a lot more down because it's riskier. It's more likely, according to a lot of lenders, it's more likely that they could flee to another country, and the lender just doesn't get their money back. So I believe we have one where it's the minimum down payment is 10%, but they have to be making a good amount and they have to have a pretty good credit score. Otherwise, it's usually anywhere from 15 to 25% down. Foreign nationals, so investors who live in another country and are buying investment properties here, just a lot higher down payment requirements. Now, this one is really cool. So for those of you who get server friends or clients, bartenders, seasonal workers, people who get paid cash, there are loans out there. Comes at a higher interest rate, but not crazy, usually 1% higher, where the employer is sent a verification of employment. So they just put on there, this is how much they make per month, sign off on it. The employer cannot be a relative, and they just send it back. And that's what the bank goes off on their income. They don't look at their pay stubs or their W-2s because, if they're a server and they're not counting all their cash, it helps. Also, if it fluctuates too much. So if you get a lender who says, hey, they're not approved because they're a server, their income fluctuates too much, we have this loan available that as long as the employer is willing to say, hey, this is how much they make, it's almost like a stated income loan, but it's a little more risky, but less risky because the employer is stating how much they make and signing off on that. Same thing with a P&L only and CPA letter. So for business owners, what I would say is, you as a realtor, if you're hearing from one person, oh, they don't qualify with this loan, a bank statement loan or traditional loan because they're self-employed, they deduct too much, whatever it might be, they don't have enough money, whatever, there are other options available. So when, if I was working with an LO and they said, hey, my client's not qualified, I'm going to ask the client's not qualified. I'm going to say, well, why not? And then I want to know the different options that are available for them. So just because one lender or one LO says that they're not qualified, it can't do the bank statement. Well, what if you did a P&L only with a CPA letter? So basically a CPA signs off that the P&L is accurate, the profit and loss statement. A lot of people don't have access to that. And so that's just something else that you can, help increase the odds of locking in more clients. It's a little different than a bank statement just because it's less work they have to put into, but also if they've been making a killing recently and lowered their expenses, it can look a lot better. Okay, land and construction. So there are land loans and there are construction loans. And then there are one-time close new construction loans. So one-time closes, I can, let's say I want to build my house and I want to finance everything. I have to get a loan for the land. Then I have to go get a separate loan for the construction. I have to pay appraisals and closing costs on both. And then once the house is constructed, I have to refinance and pay closing costs on that refinance in order to get a traditional mortgage. There are now one-time close new construction loans where essentially I can get financing for the land, the loan in place for the construction, which the contractor has to be picked out, plans have to be somewhat in place. So it can be a longer escrow period and longer loan contingency period, but then I can close and have the loan in place to finance the construction. Next is commercial. So actually we're adding on someone. So if you get any borrowers who want to buy a commercial property, so this is separate from large apartment complexes. We have lenders who specialize in that. And then we just added a kind of a lender. It's kind of like a partnership. If anyone wants to buy commercial properties. Cool thing about the commercial properties is you can seller finance the down payment. There's a lot more nuances with that, but you can do that. So it's very interesting. Now with HELOCs, bridge loans, cash out refinances, these are just other loans that you'll hear about. If they want to be able to buy a house and then sell their house after because they want to be able to move out, fix some things up, make it clean, ready to sell, there's bridge loans. So essentially they borrow against their equity and we can do it at 0% interest as long as they use the same lender to get the loan for their main place. And then when they sell it off, they pay off that bridge loan. A home equity line of credit is just that. It's a fixed interest rate line of credit it's like having a credit card with a fixed interest rate, but I can use it almost for whatever I want. I have to be very careful that, like, there's some things I would leave that up to the lender to explain that I can't use it for, as income, whatever. And then there's cash out refinances. So cash out refinances, let's say I've got 30,000 in credit card bills and maybe I have a 3% interest rate on my house, but I can't pay off my credit cards because it's an adjustable rate. And so the adjustable rate keeps going up. It's 28% right now or whatever it is. I can refinance my house, yes, maybe at 6.8%, so double what I'm currently paying, but I can take cash out and pay off those credit cards, and I'm still paying a significantly lower interest rate total. And so it's just another option that you can provide people, or if you have investors who are looking to buy more properties, they can do that. Or right, clients who are like, well, I have a lot of appreciation in my house, a lot of equity, but I have not saved up any money. Maybe I'll use one of these three options to buy my next house and then rent out my current house. Does anyone have any questions about some of these loans? I'm trying to fly through a lot of this, but I know it's a lot. Is everyone still there? Hopefully this is not overwhelming. I'm sure it is. Okay. One of the main ones Vivi asked was points buy down 10, 11, 21, 321. I like that emoji. Points are, it's hard to explain points, but essentially points is the cost for the interest rate and cost for the loan. So they if I wrap any costs into the loan, it gets expressed as points. And so they sometimes you'll hear it be called basis points as well, or sometimes just points. And so if I take an interest rate, so I get a borrower and I say you're qualified at 6% as a par rate. That means it does not cost you anything in order to get 6%. If you'd like to get 5.85%, that's going to cost you, or 5.75. It might be a 1/4% difference, but the bank, when they express that fee, because it's based on a loan amount, it's expressed as a 1 point. And so it's 1 point would be 1% essentially of whatever loan amount they have. That's why, if I say, well, how much does it cost to buy down this interest rate? It depends on their loan amount. And so you'll get some people who want to permanently buy down their rate or have to in order to qualify. And so if they qualify at, let's say 6% is the par rate and their loan amount is 200,000, right? 1 point would be 4,000 to buy down the rate. You don't have to worry about the calculations. It's just that's what they're talking about. It does get super confusing, and I wish they would express it more as just a percentage, but yeah. I'm going to show you some examples here in a second, but there is permanent buy down and then there's temporary buy down. So a lot of these 1.0s, 1.1, it's just, it is what you see. So it's 1% less than whatever rate you qualify at for the first year, and then it goes to the qualifying rate. So if I get 6%, and I get a 1.0 buy down, I can either have the lender pay for it, which just means technically I pay for it. I get a slightly higher interest rate, or I can have the seller pay for it. It's one or the other. And so in the seller, it could be the realtor giving a credit, but yeah. But essentially, if I qualify at 6%, then I would get 1% less for the whole first year. A 1/4% difference in most people's loans is very irrelevant, and I'll show you in an example, but 1% less can save them a few $100s. There's 1.1 where pretty much for the first 2 years, I just get 1% less, right? Then it goes to 6%. It's not adjustable. It just, for those first initial years, I'm using the temporary rate buy down because I'm planning on either just saving money and refinancing. Like, let's say I have a conventional loan and I want to be able to save some money to put back into the house. And then in 2 years, I want to refinance because I know I'm going to have an increase in equity and I'll be able to remove my mortgage insurance. Then it might be better to do a temporary rate buy down. Or like today's market, if I'm anticipating that rates are going to drop, I want to be able to have a lower payment now, and then when rates drop, I can refinance. What's nice about the temporary rate buy down is that credit that was used gets prorated and applied to their principal balance. So if I'm looking at, hey, I just did an inspection on this house, there's 5,000 in damage, they're giving that as a credit. Sure, I could permanently buy down the interest rate, but if in 3 months rates drop below that and I choose to refinance, well, that credit that I got from the seller is gone. And I can't, like, that sucks. I just refinance and that credit's gone. If I did a temporary rate buy down, then if in 3, 6 months rates drop, I at least get that some of that credit back towards my principal balance. Hopefully that makes sense to everyone. And then adjustable rate mortgages are just, they're based on certain calculations, based on different indexes. A lot of times they can be locked in for 5, 6, or 7 years. And so you get in whatever rate you qualify at. A lot of times it's a lot lower than current rates sometimes. In 2022, there were a lot of adjustable rate mortgages that were like almost 1% less. You're locked in for 5 years and then they adjust. So for some people, they were saying, well, I'm going to play the game that in 5 years rates are going to drop enough that I'm just going to refinance and not have to have this adjustable rate going on. Does that make sense to everyone? Okay. Can all loans buy down or use it? Yeah, so I meant to say, can you buy down an interest rate with all loans? No. So a lot of the down payment assistance programs, they don't offer this. You can't buy down the interest rate at all because it's risky if they're giving free money. Some of them you can. Not all lenders even offer any buy downs. So like we have access to some lenders that just have really low interest rates, but they don't offer any of this. So it's unfortunate. Some only offer it on some of their products where others don't. So once again, back to that question of, do we always shop for the best interest rate? No, because sometimes the best interest rate doesn't mean that the cheapest loan. Sometimes they charge more fees. Sometimes I can get more creative. Sometimes they're more lenient. And for the realtor, I want my lender to not to always choose the lowest rate, but the person who's going to have the best process. Because I've had it where they did not choose the best process lender. They chose the lowest rate and they saved the borrower 0.25%. However, that lender delayed things because their underwriters were just so strict and they had so many additional requirements that it delayed us 30 days. And my buyer ended up having to pay the seller an extra $1,000 to keep it into contract and I had to pay some out of my own commission because the seller was having to pay for movers and pay for hotels. And so we were delaying it. So if you ever do work with a broker, I might tell borrowers, hey, I can always shop for the best rate, but I'm not really going to always shop for the best rate because it's not always going to be what's best for you. Does that make sense to everyone? All right. Well, so now I want to give a little bit of a scenario. So this is my loan operating system. LOS is what they'll call it. So when I talk with a client, and as much as I can, I try to Zoom with them to show them this, right? When they fill out their application, all of this info is going to input everywhere. When I pull their credit, it'll put everything here, but I'm just doing this as an example. This isn't actually me. But their monthly income will be here. It'll give me flags if they put that they haven't been there for more than 2 years. It'll tell me all kinds of info. What I can do then is, right, I put in the loan information. So I say, okay, purchase price, let's say is 500. The appraised value is 500,000. Their down payment, let's say, is 5%. They're going conventional. I know that with some of them, the mortgage insurance is calculated at 2.1% or 0.21% of the loan amount. But the system auto calculates it. So when people say, well, it's principal, interest, taxes, and insurance, yeah, well, you have your principal, you have your insurance here, you have your taxes, 1.25%, you have your mortgage insurance. And so there is their monthly payment. I can put the interest rate here. Then I can come over here to products and pricing, and I always say, okay, so based off the credit score that you gave me, of course, it's going to take forever to load. Let's say they said their credit score is 750. They're looking in Placer County, conventional. Then I can go and I say, okay, like a lot of times I'll talk to you all and I'll hear, okay, they're looking all over. It's not a competitive market. It is a competitive market. Then I just know which lenders to choose from. We have more. It's just they're not all integrated with this, which is so much fun. And then all I do is I click that and I click price, and it gives me these examples. I don't know why this say expired. Oh, so rates adjust constantly throughout the day, so they're probably adjusting right now, and they haven't updated these costs. So, for instance, this is one of the main ones we use. We're going to probably start using this one as well, but UWM. So with UWM, I get like partner credits, and so right now this is what they call the par rate. So this is the lowest cost for the borrower. So 7.625%, which that's where rates are at today. It would cost the borrower $532. I know with this specific bank, I can, because I'm like a preferred partner and I take courses with them and I get these extra points, I can apply my partner points so that they don't have to pay for it. I can actually apply almost enough to cover the cost of this, so I can get them around 7.375. That is where a lot of these other banks are at. However, I know that these banks are going to have significantly higher, probably about $100 more in mortgage insurance. I also know that these two banks, this is actually the same lender, try not to say bank, their process is a lot more complicated. I know with this one, I can actually get the appraisal waived, the appraisal fee, and I know that the credit report is about $200 cheaper when I go with this bank. So even though they have the same closing costs and I have to apply some points, I'd rather go with them. Plus, if you as the realtor, you're looking at a competitive market, I know the fastest one I personally have ever done was when I submitted it to their underwriters, the loan, from when we got the clear to close was 6 days. That was still, the borrower didn't have all of their documents. I've seen it done in like 4 days. Or sorry, no, 6, because they did have to do the appraisal. If you get the appraisal waived, then that's a whole nother. So, right, this is where the debt to income ratios get calculated, and this is what we end up having to look at. And so a lot of times you all will send a client to a lender and wonder, hey, how come the pre-approval is taking so long? And it's because this number dramatically jumps up. And so I look at it and I say, okay, well, what purchase price do I need to get them under? Like, let's say me as an example, I'm looking at 700,000. I can't qualify conventional because it's too high. It's over 48% or 49%. And so then I have to look at it and I say, well, they technically said that they could put more than 35,000 down. They said they're willing to go up to 10% down. So how much is that? Okay, well, there we go. So if they do 10% down, they qualify. Does that make sense to everyone? Sometimes I have to go back over here and I have to say, okay, well, let's say I look at this and you told me that they're looking at some fixer-uppers. And so what if we got a credit towards closing costs? Okay, so if we got, let's see, if they're looking at 700,000, if we got 2% in closing as a credit, so that's 14,000, we could buy down the rate to here, and maybe that is what we need in order to get them to qualify. Apply, whatever. And boom, they're qualified. Is that example making sense to everyone? I'm trying to use that so that you understand that, sometimes people will say, hey, our typical, we can get someone pre-approved in 24 hours. I mean, if they send me something right away, I can get someone pre-approved in an hour. It takes 20 minutes to fill out the application online. And if they are organized and they've been with the same employer for a while, they can send me everything in another 10 to 20 minutes. And so I can just take a look and say, boom, pre-approved, less than an hour. Other ones though, and most of the time, especially in a higher interest rate environment, it's just going to take a lot more creativity. Like I said, we have access to about 15 different lenders. You only saw really 4 or 5 on there. So if I need more creative financing, I got to look into what their requirements are. But what I like to do in the next part of our slide is figure out where are we going to get caught up. And so, why is it that loans fall out? Of course, this is the last one on the slide. Why do loans fall out? It's because I choose different lenders where I don't know their requirements. Or sometimes I had to rush a file, not me specifically, I'm just saying, or someone had to rush a file and they weren't able to find out all of the details. For instance, like I had a client who I was representing them as the realtor. They sold their house for less than what they thought. And then they had a reverse mortgage on the house and they owed more than they thought because it negatively amortizes. And so what ended up happening is when we sold their house, they did not have enough money that was required, even though they were putting 50, 60% down, they did not have enough money in order to qualify. So what they had to do is they had to liquidate a bunch of stocks that was being used as their income. And then they had to switch over the annuity that their deceased wife left them to their name. But then annuities are calculated differently because it's not whatever you make from the annuity, it's the life of it's so confusing. So sometimes it's just the situation, right? Sometimes the insurance quote for fire insurance comes back a lot higher than expected. A lot of times, though, it's either the borrower did not disclose certain things and they rushed getting the file, or my own personal opinion is most LOs will take the application. They'll ask for only a couple documents. And I've literally been taught this by other lenders just to do this. And I'm like, no, I want to get as many documents up front so that there's no hiccups down the road. But what most LOs will do is they'll say, yeah, just send me your last 2 pay stubs, last 2 bank statements, and your driver's license, and you're pre-approved. And it's like, okay, but they said that they have 50,000 to put down, and that's not showing up on their deposits in their bank statements. So where is that money coming from? Maybe you need 4 months bank statements to show that for anti-money laundering laws that the money actually came from them. So, that I just think that sometimes the pre-approval might take a little longer, and that's probably a good thing, right? You want to make sure that someone gets pre-vetted as much as possible because it's only going to help you down the road as the realtor. Obviously, I think you should explain to the agent, or the LO, hey, they want me to show them a lot of houses. Can you at least give just a ballpark idea on the monthly payment and qualification so I'm not wasting my time and we're not looking in the right price range? Then yes, I'm going to sit down and say, hey, I would not look at houses over this because I have a feeling they're not going to qualify. But I still need to really dive into it. Right? Does that make sense to everyone? And no, I don't shop for rates. I shop for service, and everyone else should do the same. It does take a lot of teamwork to set expectations with your clients. Um, you know, are closing costs going to be the same? No, they're very different from each lender. And then turn times are also very different. So we like to use a bank United Wholesale Mortgage because we like literally take classes and watch their trainings, and we use their platform a lot. And so we get expedited turn times. Like we're called a diamond something status, because as a brokerage, because we're the top, just because we educate ourselves. It's very silly, I know, but because of that, we get faster turn times on everything. So if I submit a document to an underwriter, they are required to get an answer back to me and review it within 24 hours, sometimes within 4. Other lenders, it's 3 days. 3 days. So anyone have any questions? That pretty much sums up. Sorry, this presentation is longer than I expected it to be, but I'm gonna stop the recording though.